Let's say this is a question asked on the concept of gross national product and gross domestic product. To solve the question, you need to have a conceptual clarity on both of these indicators. And that's exactly what we will be doing in this episode of Economy for Beginners. Hello, welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. In this episode, let's try and understand the concept such as a gross national product, gross domestic product, net domestic product, and net national product. But before I start the discussion, very recently we held the Manzil event, during which I interacted with multiple toppers of the Civil Services Exams 2024. The five mantras that they followed to ace the examination were: they've covered the static portion in detail, solved multiple test papers, revised updated current affairs, and also had a look at previous year question papers. What if I say all of these five mantras are available to you to avail if you purchase our courses, which are available at a price of 17,999 rupees? The offer is available for the next 48 hours, that is till the end of 30th April. Those who are interested, please check out the details by clicking on the link provided in the description below. Now let me start with the first indicator, gross domestic product. Let me define this first. The market price of all the final goods and services which are produced in the territory of India is called as gross domestic product. Let me give a very simple example here. Imagine there are 6 biscuit packets which are produced in India and 4 cars which are produced in India. And let's make it simple. Assume these are the only final goods and services produced. If you assume the market price of 6 biscuit packets as 10 rupees and cars as 20 rupees, the market price of all the final goods and services will be 140 rupees. This, my dear, is the gross domestic product. But more importantly, please make a note of this particular point. The gross domestic product is a geographic concept. That is, all the final goods and services which are produced within the territory of India will be counted as part of India's GDP. Whether these are produced by foreign nationals in India, foreign companies in India, Indians residing in India, doesn't matter. As long as these are produced within the territory of India, these will be counted as a part of India's gross domestic product. Now, GDP is measured using 3 methods. If you want to understand in detail the 3 different methods, there is a separate video on this. Please check this out. So in a nutshell, this is gross domestic product. Now let me go to the second indicator, gross national product. Let me define this first. Gross national product represents the market price of all the final goods and services which are produced by the residents of India. By the residents of India. Whether these are present within India or outside India, doesn't matter. As long as this is produced by the residents, this will be counted as a part of India's GNP. Let me explain and then I'll make you understand difference between GDP and GNP. Now let's say here is GDP of India. Let's make it very simple. Imagine there are 2 people, A and B. A is citizen of India, present, working in India. If the amount of income, factor incomes generated by A is 60 rupees, and let's say B is a foreign citizen who has come to India for a period of 3 months, and during which, let's say, B will generate income of 40 rupees. So GDP will be calculated in one of the methods using the factor income. Total GDP of India in this example will be 100 rupees. But when you move from GDP to GNP, GDP is a geographic concept, territorial concept, whereas a GNP is a nationality concept. So when you move from GDP to, let's say, GNP, what I'll do is I will basically not count, I will subtract this particular value of 40 rupees. Reason being, this is the factor income generated by a foreign resident. Foreign resident who is present in India. So what I'll do, I will count only the 60 rupees. This is a Indian resident present in India. But will this give me the total GNP? I will have to make one more adjustment. The adjustment is, what if there is another individual C, Indian resident, who has gone to USA for a period of 3 months, generated income in USA. So what I'll do, if the C has generated income of, let's say 50 rupees, I will essentially take 60 rupees, which is the factor income generated by resident of India present in India, and this 50 rupees, the factor income generated by resident of India but residing outside India. The total 110 rupees will be the gross national product. Now, I know some of you might be thinking, sir, how do I understand who is a resident, who is a non-resident? According to the United Nations methodology, if a person resides in a particular country for up to 1 year, let's say Indian citizen goes to USA for a period of 6 months, still will be counted as a resident of India. A foreign citizen will come to India, work for let's say 6 months, not a resident of India, a resident of USA. So this is basically the formula you can use to calculate the gross national product. And there is a difference between both GDP and GNP, which should be pretty much evident to all of you now. Let me go to the third indicator, net domestic product. So whenever you talk about these indicators, you will come across two terminologies. One is gross and the second one is net. What is essentially the difference? Gross means aggregate. Gross means total. Whereas net means from the gross, you will make certain adjustments to arrive at net. For example, your gross salary will be 1 lakh rupees. But will you receive 1 lakh rupees at the end of the month in your bank account? Answer is no. From 1 lakh rupees, a lot of amount will be taken out in the form of income taxes, professional taxes, contribution to social security benefits, etc. etc. And after that, a certain amount or remaining amount will be transferred to your bank account, that is called as net income or net salary. But what is essentially the idea of net domestic product? Let me define this first. It is a market price of all the final goods and services produced within the territory of India after adjusting for depreciation. Now there is one more term, depreciation. I will not go to the accounting concept of depreciation, but I'll just give you the basic idea here. Depreciation essentially represents the amount of money that you spend to replace existing capital. What do you mean by existing capital? Let's say you start a company. You started the company in 2015. You purchased a machine. This machine now is 10 years old. Worn, right? Very less efficiency, not working properly. So after 10 years, that is in 2025, you will be replacing this old machine with a new machine which is produced in 2025. So let's say I will calculate GDP and let's imagine only two goods are produced in India, final goods and services. One is a car, second one is a machine. Second one is a machine. If I allocate numbers, let's say car is worth 50 rupees, machine is worth 50 rupees. GDP of India will be how much? 100 rupees. But what if I say this machine which has been manufactured here will be used to replace the old machine that you had purchased in 2015? Don't you think GDP number will not give you this information? So what you will do is you will calculate one more indicator called as net domestic product. NDP essentially will be calculated as gross domestic product minus depreciation. And what is the importance of this indicator? This indicator will tell you how much of the final goods and services are actually value added to the economy. how much of the machineries are addition to the existing capital, and how much of these machineries, that is the capital, is used for replacement of existing capital. So in a nutshell, please remember, compared between GDP and NDP, NDP will give you quality information. So this is a net domestic product. Next one is NNP, net national product. What is this net national product? It is simply the market price of all the final goods and services which are produced by the residents of a country. By the residents of a country, whether residing in India or outside India. Doesn't matter where it is being produced, where the income is getting generated, doesn't matter, as long as it is produced by the residents, but after adjusting for depreciation. Again, remember, whatever is the final goods and services produced by the residents, some of it will be used for replacing the existing capital. And when you calculate GNP, that is the market price of all the final goods and services produced by the residents of a country, and from this you adjust it for depreciation, what you get is net national product. If I want to give you an example in terms of calculation, let's say the total incomes generated, that is the factor incomes generated by the residents of India who are working in India, let's say is 50 rupees, and the factor incomes generated in the form of, let's say, rent, in the form of, right, let's say interest, in the form of wages by the residents of India outside India, let's say this is another 40 rupees. So 50 plus 40, that is a 90, will be the gross national product. And I know some of you might be thinking, sir, how are you calculating using factor incomes, etc.? What is factor incomes? Again, I repeat myself. There is a video, again titled Economy for Beginners, episode 1, where I have discussed the different methods to calculate GDP. One such method is the factor income method. Please do have a look at it. So out of this 90 rupees, let's say depreciation is 30 rupees. So if I deduct 30 rupees out of the 90 rupees, remaining 60 rupees is the net national product. So there you go. These are the four indicators: gross domestic product, gross national product, net domestic product, and net national product. Having understood these particular four indicators, let's solve the question which I had given earlier. GNP of a country is higher than the GDP of the same country. Which of the following is likely the reason? If compared to GDP, GNP is increasing. What is the reason? What is actually happening? Reason is very simple. From rest of the world, how much residents of India are earning from outside India, this is actually increasing. Is my concept, is my argument okay with all of you? I'll repeat this again. What is the difference between GDP and GNP? From GDP, I will subtract factor incomes generated by foreign residents who are present in India. And I will add the factor incomes generated by residents of India but working outside India, abroad. So when I say GNP of India is increasing, it is becoming higher and higher compared to GDP of India. What is essentially happening here? The factor incomes generated by the residents of India but working outside India is actually increasing. That's a precise reason GNP is becoming bigger compared to GNP. And that is essentially the right option for this particular question will be option C. Net factor incomes from abroad is positive, is increasing. Right? So that is the reason why GNP for a particular country will be bigger than the GDP of that particular country. So these are the four very important indicators. But before I close the session, let me ask a very simple question. Between GDP, GNP, NDP and NNP, according to you people, which is the indicator which will give you more quality information regarding the incomes generated by Indians. I'll repeat the question. GDP, GNP, NDP, and NNP. There are four indicators. Which is the most qualitative indicator which will give you quality information regarding earnings done by Indians? Do let me know the answer to this particular question in the comment section below. That's it from my side in this particular session. If you like this video, do not forget to hit the like button. If you're yet to subscribe to our YouTube channel, kindly do it right now. Thank you. Have a great day.